To jest podcast System Trader, odcinek 21.
Interesujesz się inwestowaniem na rynkach kapitałowych? Szukasz swojego sposobu na oszczędzanie i pomnażanie pieniędzy? Zastanawiasz się, jak postawić swoje pierwsze kroki na giełdzie? Ponadto fakty, mity, wywiady i ciekawostki ze świata finansów. To i wiele więcej usłyszysz w podcaście System Trader. Zaprasza Jacek Lempart.
Larry Connors to człowiek z ponad 30-letnim doświadczeniem na rynkach finansowych, bardzo poważany w branży, zwłaszcza w kontekście krótkoterminowego handlu algorytmicznego. Jest autorem wielu uznanych pozycji książkowych, takich jak How Markets Really Work czy Short-Term Trading Strategies That Work. Larry jest również współautorem książki Street Smarts, którą napisał wraz z Lindą Raschke, z którą miałem przyjemność rozmawiać w odcinku numer 5. Książka ta została wybrana przez Stocks and Commodities Magazine jako klasyka XX wieku pośród książek poświęconych tradingowi. W tym odcinku rozmawiam z Larrym o jego najnowszej książce zatytułowanej Buy the Fear, Sell the Greed – 7 Behavioral Quant Strategies for Traders. Jest to świetny dowód na to, że ekonomia behawioralna nie tylko działa, ale można ją skwantyfikować i użyć na rynku. Zachęcam do wysłuchania całego odcinka, gdyż Larry prezentuje w nim kompletną strategię opartą na pewnej obserwacji zachowania się tłumu. Jest to bardzo prosta idea, zarazem bardzo skuteczna i ponadczasowa. Zapraszam do wywiadu. Hello, Larry.
Hello, Jason.
Thank you very much for being here today on my show. You are a very well-known person in the financial industry and author of many great books. Could you please tell us here a bit more about yourself, especially from the perspective of your trading career?
Sure. So I started trading a number of decades ago. I started trading on my own in college. I basically worked a couple of jobs, had my own business there in college, and was able to take some of the money and begin trading the markets, begin trading the penny stock markets back then. And shortly after leaving school, I went to work for Merrill Lynch back in 1982. Spent 13 years on that side of the industry. I was on the sales side of the industry, and ultimately went off to trade for myself and also to build out a research firm beginning in 1994. And from there, we built out the trading markets website. We published a number of books, including Street Smarts with Lindą Raschke, and it's been a pretty fun ride along the way. I came into the industry when the Dow was somewhere around 700. So that was many thousands of points ago.
Wow, that's very interesting what you say. Thank you for that. So it sounds like you have almost 4 decades of trading experience.
Yes, that's correct.
All right. You have just published your latest book titled Buy the Fear, Sell the Greed, 7 Behavioral Quant Strategies for Traders. It's a great source for a discussion, which I believe may be very interesting to most traders. On its very first page, in fact, you reject the efficient market hypothesis that states that asset prices fully reflect all available information. Before going into more specific details, could you please explain why many traders are psychologically unable to take trades in times which historically prove to be large urge, high probability trading opportunities?
Yes. And that's a great question, because that's the thesis of the book and the statistical backing of the book is that at certain times in certain market conditions, especially on a short-term basis, fear and greed will overwhelm the markets or the individual stocks themselves. And what happens is irrational behavior will occur. This type of behavior that has occurred is essentially inherent in humans. This goes back centuries and centuries of time. It's hardwired in there. And what happens is there, on a very short-term basis, prices will become mispriced. Edges, at least on a look-back basis, historically have provided edges that we've been able to quantify this over and over again. Some of this we quantified a few decades ago. And as you move forward from the time that we initially did the quantification, you get to see the same behavior repeat itself over and over again. Fear will come into the marketplace. Prices will sell off. The prices of the securities and whether they're markets or ETFs or individual stocks will become mispriced over a very short period of time. And then ultimately the fear subsides. And when the fear subsides, the buying comes back in and prices go back and readjust to levels where they should be. And that's where the healthy edges are in place. Why people oftentimes can't pull the trigger during those times or take the trades during the times, there's a multitude of reasons. Number one, fear as a whole will tend to seize people's decision making. This is true. This has been true throughout mankind. You could see this in the military. You could see this in business. You could see this in the markets. So that makes for irrational decision making over a short-term period of time. Number two, there are a lot of controls in place when we start looking at the bigger money that's out there. So when we start looking at, for example, institutional money or bank money, there are risk managers that are overseeing the trading desks. And what they're going to do is, even though there are going to be great opportunities for the traders to take advantage of, the risk manager's job is to protect the organization. And what they're going to do is, what they often do is they'll tend to shut those traders down. And those are opportunities that are usually missed. So the traders who are there and able to take advantage of them usually have the edges. And we've been able to show this now for many years. And now it's come on to be decades for us to be able to show this on a statistical basis.
Okay, great. Thank you very much for that, Larry. Very interesting. In your book, basically, you quantified mainly edges which are quantified, let's say, driven by the behavioral factors. And does it mean that, in fact, there are times where such analytical tools like technical analysis or fundamental analysis, that there are times it just doesn't work, that the emotions are in the first place?
Well, the emotions are creating the edges. I used to believe that the technical factors were there. So, I come from a technical background, at least initially. So the technicals, it used to be my original belief that the technicals created those edges, but in fact, it's really the price itself is creating the edges, and the prices basically the prices are at least mispriced, primarily due to behavioral factors, and especially when it comes time to fear. Fear is the strongest emotion out there. Fear tends to permeate amongst a great deal of decision making, whether it's on a daily, weekly, or on even a lifetime basis. So when fear comes into the marketplace, you will see prices tend to change. You will see behavior tend to change. And when behavior changes, it creates the mispricings, which can be taken advantage of.
Thank you for that. Very often traders are asking themselves, including myself, how markets are changing over time. Currently, we have very fast computers, high-speed internet connections, we have social media, we have high-frequency trading, we have artificial intelligence. How all this influences the markets? Is our human nature also changing with the technology, or the only changing factor is just timing?
Well, the things that you mentioned here are all good points. Those are all structural changes in the marketplace, and structural changes have always taken place. Structural changes will continue to take place. What hasn't changed is human behavior. Human behavior, it's inherent. And you see where I open up the book. I open up the book with a quote from them, Major Patton, but ultimately it was General George Patton. But when he wrote what he wrote, it was backed I believe it was in 1924. And he basically stated that the emotions felt by soldiers today, of the warriors today, the same emotions felt by the warriors centuries before. And that's true in when it comes to military, comes true to war, and it's true when it comes to trading. Those same emotions are in place. So all those structural things that you just mentioned are true. What hasn't changed are the people behind it, the behavior of the people behind it. Does that make sense, Jason? Does that make sense? As I just
yes, it does make sense. Definitely, it does. Yes. Do you think that then strategies based heavily, especially on fear, and also on greed, but mostly, as you said, on fear, do you think that such strategies tend to be more robust than other? Because we often see how strategies degrade over time, and longevity often is an issue. So we may find some market edge which then suddenly disappears once more and more traders notice the same inefficiency. Do you think that if we have a strategy based on fear, such strategy may be more robust?
I do believe it is more robust, and part of that is because, as I pointed out in the book, some of the tests, some of the strategies in the book we originally tested as much as a decade and a half ago. So we created those strategies, for example, a decade and a half before. So that was on a look back basis. We got a chance then to look forward over the next 15 years, and you could see that in some cases, in certain symbols, the strategies actually got stronger during that period of time. So even though they were published in the public domain as much as 15 years ago, the strategies continue to hold up in the testing. The behavioral aspect is inherent, and I don't believe, and again, this is just my opinion, but I don't believe the behavioral aspect is ever going to change in humans. That's where traders can come in and say, based upon certain market conditions, when fear comes into the marketplace, can I take advantage of these situations? And Jessica, I do want to add one thing to here, and I pointed this out in the book. The behavior when markets are in bull markets, and I define bull markets as being markets that are above the 200-day moving average, tends to be different than behavior below the 200-day moving average. So fear when the markets are rising, so again, above the 200-day moving average, tend to provide, at least historically, have tended to provide better opportunities when they've pulled back than when fear has come into the marketplace when it's below the 200-day moving average. So we definitely want to be able to identify what is the longer-term emotion in place, what's the longer-term sentiment that's in place. We can do that with the 200-day. And then on a shorter-term basis, what we can do is use some of the indicators, for example, that simple indicators that I pointed out in the book that can allow traders to be able to pinpoint where their entry should be, where their exit should be, and then be able to look back many years and in some cases decades, what have been the historical results during these times.
Okay, that sounds very interesting. It's very amazing that, as you say, although some rules are publicly known, the edge is still there, and it's not that it disappears over time. When you mention fear and greed, you often refer, at least in the book, to strategies predicting the short-term direction. And as you mentioned also, some strategies have a very high winning percentage. What about then long-term predictions? Can we also use behavioral factors here?
The answer is yes. It's not. I don't cover this in the book, but I'll share it here in this podcast. So what we see is two things: that on a short-term basis, prices tend to mean revert. So let's say it's above the 200-day moving average. It becomes oversold. It will then tend to revert back. Sometimes it's referred to by the dips. But essentially what it's looking to do is on a short-term basis, we see mean reversion, and at least we've seen it for decades, mean reversion in equity prices. That's an important point that I should stress out, that we see this in equity prices. We see it less so, for example, in commodities and currencies. That same type of behavior, at least on a data-driven basis, has not been found in those markets. But when we look at equity prices, and especially, for example, in the United States, prices tend to mean revert. On a longer-term basis, prices tend to trend. And there's a gentleman out there who's now joined my research team by the name of Chris Kane. And Chris is going to be coming out with a book that basically shows on a data-driven basis, he quantifies how behavioral factors influence prices on a longer-term basis where they tend to trend. There's a number of behavioral factors that come into that. And if people want to be able to at least get to follow Chris, they can find Chris on LinkedIn. It's Chris Kane, C-A-I-N is how his last name is spelled. But I've read some of his initial writings for his book that he has coming out, and it's pretty fascinating to see that he is able to show that on a behavioral basis, longer term, that herding factor, H-E-R-D-I-N-G, has a lot to do with prices moving up, trending, equity prices trending. And you really see it not only in equities. Chris shows it in bonds. He shows it in a number of other markets. It's pretty fascinating. So for everybody to baseline this and to start it, think on a short-term basis, mean reversion, and on a longer-term basis, think trend following.
Yeah.
Does that make sense?
Yeah, definitely it does. Thank you very much for that. It's very interesting. I will put all the details on my website so everyone can go on my website and check it out. Do you think, Larry, that using quant fully systematic approach helps to profit from market anomalies where fear and greed play the role? Everyone heard about buying fear and selling greed, but we all know that it's very difficult. So therefore, that's why probably these edges are there. In other words, do you think that the discretionary trading approach is harder in terms of exploiting such events comparing to the algorithmic approach?
Yes, it's absolutely harder. So I've worked with traders, including work with traders on a one-on-one basis for a number of decades now. And the number one thing that I see that's the hardest to do is to be able to execute trades when fear is at the greatest. And it's fascinating because I've worked with a number of traders, whether they range from professional traders, meaning that they were on the floor of the exchanges and then they moved their operations, they expanded their operations upstairs, all the way up to people who moving all the way to people who were traders that were looking to become full-time. They had corporate jobs and they were looking to become full-time traders. The one thing I see in common, the hardest thing to do is to be able to go in when the markets are selling off and there's a whole bunch of noise out there, and that noise is coming from the news channels, it's coming from CNBC, it's coming from social media now, especially. It's very tough to be able to step in. So having a systematic approach where it's almost in a sense, if you could have someone take the trades for you, so you hire someone as a trader, or your computer, or you're set up to be able to systematically execute, so one doesn't have to physically make those trades. In my opinion, that's a large competitive edge because, again, most people really do have trouble taking those trades when the fear is at the greatest. I mean, we're all human, and having something systematic in place that basically sees the trade and takes the trade is a large competitive edge versus everyone else.
Yeah, that's very interesting. But on the other hand, one of the pitfalls of algorithmic trading is, as we know, overfitting data, especially now with very powerful computers and genetic programming, for example, and so on. Inexperienced traders tend to trade the data, as we say. So even if the underlying model is not logical, doesn't make any sense. Do you think that quantifying repeatable human behavior helps to avoid overfitting data?
Well, it's good that you said that, trade the data. I think that I used that phrase within the book.
Yes, I took it from your book. Yes.
Yeah. So, I attended a wonderful conference here in New York City, earlier in the year. It was called QuantCon, and it's put out by Quantopian. It really is, if anyone gets an opportunity, people coming from around the world to attend it. They have wonderful speakers. And you see the makeup of the people that attended that. A lot of them with heavy-duty data experience, and whether they had degrees in engineering or in any of the sciences or any of the data sciences. And some of them had master's degrees and PhDs, and you could see this trade the data mentality. I could very much see that. Trading the data is, depending upon how that data it's oftentimes does not work. And, you could see it, especially this year. A lot of quant funds are having a lot of difficulty this year. They had a lot of difficulty in October, because they were, in some cases they were trading the data. And some of these, major funds had double-digit drawdowns for the month, which is pretty horrendous. If you think about it, when we start looking at things, number one, I want to try to understand before I'll put a strategy. I take the approach of saying, okay, what is going on here with the market? Why is this going on? What is the inherent edge that's going into place? And then how can I best construct the strategy and ultimately construct it within a portfolio that, if I'm wrong, it will it's not going to potentially take the account and bring it down double digits. It may cause a drawdown, but keeping that risk contained. What happens with the trade the data is if one doesn't quite understand what is the behavioral aspects behind it, why do these edges exist? What ultimately, I've seen this over and over again, they tend to blow up. These things just stop working. And that's simply because they overfit the data, or curve fit the data and did things within the data. One of the rules that maybe everybody can then apply is basically, we like to see things with the least amount of rules possible. And you can see that throughout the book. In the 7 strategies that are in the book, majority of the strategies, in fact, all the strategies only have a small handful of rules, and you can understand the reason behind the rules. There's behavioral reasons and aspects behind the rules supported by the historical test results.
Warren Buffett is known saying, be fearful when others are greedy and greedy when others are fearful. And we know also from your research that it can be statistically proven, and in fact, you are proving this in your book. But on the other hand, we have approach to trading like long-term trend following, where basically we buy the strength when the market is going up. We are buying the strength, and we are selling when the market is going down. We sell the weakness of the market.
Yes.
But this seems to be an opposite idea to what Warren Buffett says, but still it seems to be working.
Yep. So it goes back to what we were talking about a little bit earlier, that on a shorter term basis, at least what we've been able to show is that that's where fear and greed comes into place on a shorter term basis. On a longer term basis, it tends to be hurting, which will ultimately lead itself to trend following. Whether one is using momentum or absolute momentum or any of the different ways to measure that trending. What Buffett has done, which very few people have been able to replicate, is there's multiple pieces to how he goes about doing these things. Number one, he's looking at panics, oftentimes looking at panics. He certainly did that at the end of 2008, early 2009. With the two of his investments, he was able to make, one of them being in Goldman Sachs. Number two, he's constructing his positions. And this is an important point because people don't spend enough time on this. And this is something that if people are looking to grow in any one part of their trading business and in their investing business, that portfolio construction and construction of a trade is as important and possibly even more important than the strategy itself. And I'll explain what this means. So when you take a look at how Buffett puts positions on, what he's often doing is he is constructing the positions in such a way that he's risking a fixed amount in order to make a much greater amount. Okay. And maybe we can talk about this a little bit further about what was done, for example, in the housing crisis of 2008 here in the United States with the bear market. Is it okay if we spend a few minutes on this? Because I think this will help everyone understand.
Yes, sure, of course. Go ahead, please.
So if you look at the people who made tremendous sums of money, and in some cases, for example, John Paulson's case, he became a multi-billionaire in there. What they were doing is they were making a bet that there was going to be a housing crisis, which was ultimately going to lead to a crash in housing prices, and ultimately a crash in the entire credit system. They were right. They were constructing trades, though, in some cases, they were constructing trades as early as 2004. And they were wrong. In many cases, they were wrong. They were just too early. So they were doing 2004, 2005, 2006. They saw what was going on, but it kept the current. What they were able to do was they were able to stay in the game by constructing positions in such a way where they would risk a little in order to make a lot. Okay. Options is one way to do that. And then going into some advanced construction, portfolio construction are additional ways to be able to do that. That's beyond the scope of this podcast. But as you could see, what they did was they were able to construct positions in such a way that when they were right, they were able to make tens and hundreds, in some cases, it was thousands and tens of thousands of times their original investment when the entire system collapsed. That's what one wants to be able to do with all this. Buffett is probably the king of being able to do that. But there are a lot of people, especially people who have done it on the short side, who have constructed positions in such a way that if markets moved as they predicted, they were able to risk a little in order to make a lot. One of the best ways to be able to do that is obviously with the option markets and derivative markets, but options especially are a way to be able to do that. Okay. So again, in looking at Buffett, it's not just simply making a market call. It also goes into the way he constructs his position and the way he constructs his portfolio. Okay.
Very, very interesting. Thank you for that. Excuse me if I ask too much now, but in your book, you present 7 strategies. Would it be possible, could you please disclose to my listeners for the good start, let's say, just one strategy, maybe some simple strategy, just to so they could feel how what is it about, and if you could describe it also a bit.
Sure. So whenever I read a book, I tend to open the book with my favorite strategy. So it's a lot of authors will tend to do that. So I did this intentionally. I opened the book after the first chapter. I opened the first strategy open up the book with the first strategy with the RSI power zones, and it's a very simple strategy. And I did this for a couple of reasons. Number one, as you can see, the historical test results are extremely high. And number two, these test results, that original strategy was created many, many years ago. And we've gotten the opportunity to, and we bring the reader in there, the opportunity to basically look forward from the time we originally published it to be able to see over the next decade and a half how it performed in the test results. And the RSI power zones can be used in most equity ETFs from around the globe. And it's a simple strategy. It's simply just waiting using a shorter term RSI. In the book, I use it as a 4-period RSI, but you can use it as a 2-period RSI, 3-period RSI, 4-period RSI. But a 4-period RSI reading under 30 when the market or when that ETF is above its 200-day moving average. Okay, 4-period RSI goes under 30. Be looking to buy a unit, and then if prices go lower anytime you're in the position, you double up on that position. And then the exit is just simply waiting for the 4-period RSI to move higher. And we can use different levels. We can use 50, 55. You can go all the way up to 70 if you're looking to be a longer term, a little bit longer term. But what you see is that 4-period RSI, when it's above the 200-day, does a wonderful job of being able to identify when there's fear in the marketplace. And it doesn't mean that there's necessarily a great amount of fear, but there's fear and there's angst. And what angst means is just simply that if we know, for example, meaning if the market knows that there's going to be a big announcement coming, let's say it's a presidential election, let's say it's a Federal Reserve making a decision on interest rates, whether it's any type of event that's out there, it doesn't necessarily mean that selling is going to occur. What it can also mean is just the buying will dry up for a short period of time. Essentially, the buyers are going to say, you know what, I'm going to wait until this event passes before I enter the market. So that lack of buying is causing prices. The natural selling will come in that's not being supported by buying. Okay, they're waiting for that event to pass. So the buyers will stand aside. The RSI will come in there below 30. It may go a little bit longer, and then ultimately that event will pass, or the fear will lessen, and prices historically have reverted back and moved higher. And as I show with SPY, we're looking back multiple decades with SPY. And in the historical test results, you can see it was approximately 90% of the time, within anywhere from between 3 to 7 days, prices were higher. And that's really high percentage trading. Again, we were able to show that a decade and a half ago, and we're still able to continue to show that as of today.
Yeah, that's very, very amazing that basically over 90% of the trades are winning. And also, just one more thing, there is no stop loss used, right?
Yeah. So again, that's an interesting point, and it's something that has created a lot of discussion that's out there. When we run certain tests and things in there, we will show certain strategies with stops and without stops. We have, for example, different strategies that have profit targets and stops in place. So it's either going to hit the profit target or it's going to hit the stop, one or the other. But what we've seen overall on a mean reversion basis, on a short-term basis, is that when you take these same strategies, for example, and put stops in place, and we actually ran tests. I showed this in a previous book, Short-Term Trading Strategies That Work, that when stops get placed in, and we were using stops that would be a couple of percent away, and then we went up to 10%, 20%. And we even showed stops being 50% away on an ETF, which is crazy because stops of 50% away, it's somewhat, that's an extreme level. Even stops of 50% away lessened the test results. Okay. And what that eventually leads to is what type of risk management comes into place. The risk management can come into place. It can be done with options. Risk management can come into place with position size. It basically is that stops are there. They do potentially play a role. But with that being said, one has to understand that on the other side of the stops is getting stopped out a number of times accumulates losses. It's just getting nicked. So it's getting nicked by a razor. It gets cut. And those losses tend to add up over time. The stops do have a place in certain strategies, but as you see with the test results on a mean reversion basis, position sizing and potentially moving over options may be better ways to be able to protect the overall positions.
Yeah, thank you very much for that, Larry. By the way, for those who are interested about more details, you are also offering the code written in AMI Broker, AFL code. So it's available. Basically, if someone is really interested and doesn't know too much about programming, everything is prepared by you, so it can be also reachable. I will put all the details on my website, so whoever is interested can just check it there. We're reaching to the end of this interview, Larry. Is there anything you'd like to add before we end today?
Yes. Well, first, thank you, Jason, for having me here today. Very much appreciate it. I always enjoy your podcast. It's one of the best out there for traders. If anyone wants to reach me, they can reach me. My email address is lconnors, LCONNORS @cg3.com. I also have information on my tradingmarkets.com website. They can also, if they're interested in reading, if anyone's interested in Buy the Fear, Sell the Greed, it's available directly from the Trading Markets website. You can just go on there and it will bring you over there. It's also available on Amazon.com. But if you bring it directly to the Trading Markets website, what will happen is you can also get access. You'll get automatic access. I have it's called the Connors Research Traders Journal. So I put out our new research on a timely basis. So if anyone wants to be kept updated, and there's no cost to that, if anyone wants to be kept updated on that, they'll automatically get that if they purchase Buy the Fear, Sell the Greed on the Trading Markets website.
All right. Thank you. Thank you so much for being here today with me, Larry, and sharing with us so many valuable knowledge. I'm sure that listeners of the podcast appreciate it very much. I wish you all the best, Larry. Bye-bye.
Great. Thank you.
Thank you. Bye-bye.
Take care now. Bye-bye.